Wednesday, August 2nd, 2023, Maneco 64, home of alternative economics and contrarian views. So big news after the U.S. markets closed yesterday. Fitch downgraded the United States from AAA to AA plus. And yes, they waited until the market closed. And you can bet that they gave a heads up to Janet Yellen and the U.S. Treasury. And that's probably why gold and silver got Mr. Slammy working hard yesterday. But we'll look at that in a moment. Before we go into the topic of what this means for the U.S. and for investors, just wanted to let you know, I recently interviewed the managing director of a company in Germany called Tradium. And they're involved in strategic metals. So those are technology metals, rare earth metals, and even gold and silver and platinum. And they're a very niche company. And they service or cater to industrial companies. But in the last 10 to 11 years, they've also been catering to private investors. And I think it's an interesting proposition. And that's why I interviewed Matthias Root, that's his name. And yes, I posted the interview late yesterday. So if you haven't seen it, come on your YouTube channel. If you haven't gotten a notification, maybe you want to watch it. It might interest you. So I'm going to put a link to it up in the cards and also below in the description. So the last time the United States was downgraded was back in 2011. And that was after the debt ceiling standoff of 2011. And it was Standard & Poor's that downgraded the U.S. from AAA, I think, to also, let's see, S&P. They downgraded it to AA plus as well. So now Fitch has downgraded the U.S. long-term debt from AAA to AA plus. One thing I would say to the CEO of Fitch, maybe he has to lawyer up a little bit, because I think the CEO of Standard & Poor's had to resign, and there's some kind of legal case against him from the regulators. So Mr. Paul Taylor, watch out. So, of course, Janet Yellen came out. I think she was interviewed on CNBC, which I haven't watched in yonks. And talking about yonks, that's the name of the toy that Rudy has, which is actually a chew toy. They call it yonks here. But Janet Yellen responds, Fitch cuts U.S. rating to AA plus. I strongly disagree with Fitch's decision. The change announced today is arbitrary and based on outdated data. I actually would say that I agree with what Tavi Costa said about this downgrade. He says here, gold, a far superior choice. Gold will never be downgraded. Gold is always golden. Is it any wonder that the word gold is used with the golden child, or you get a gold medal for winning, or everything that's related to gold is good. You never hear you're gonna get a paper medal for winning the Olympics 100-meter dash or something like that. You get a gold medal. So yeah, I agree with Tavi there. All fiat currencies, of course, are junk in my opinion. But be as it may, I just wanted to show you how the United States compares to other countries. So here I've got a list from Trading Economics. And I'm not sure why Australia is AAA rated AAA by all these major credit rating agencies. No offense to my Aussie viewers, they probably have the same opinion as I do. You can see that the U.S. is down the rankings here right now. So AA plus by S&P, AAA by Moody's still, AA plus by Fitch now, and AAA by DBRS. I think DBRS is a Canadian rating company, if I'm not mistaken. They're called Morningstar. So what does this really mean for not just for the United States, but for investors? Well, the lower your debt rating is, the more it affects investors, how they see your debt, how they price it as well. And it even can eventually affect the amount that they buy, because some mutual funds, some investment funds, they have a limit of how much, how far down the ratings can be in order for that fund to buy that debt. So if the debt were to get even worse, it might not be something that investors will look into. So it will affect how much of that debt will be bought. And this is interesting because I think it gives the BRICS and the other countries outside the Western world who are trying to get away from the dependency on the dollar, that will give them a signal that they're doing the right thing, actually. And for all those of you out there who are still in denial, I think you need to keep an eye on this. So that's how it affects the pricing. I remember when I worked in the city and I started out doing a lot of cash bonds. Some of my colleagues did corporate bonds, and the question was always, if you were going to deal in an illiquid corporate bond, they always ask, well, what's the rating? Well, that's going to be LIBOR plus 100. If it's triple B, if it's AA, it's LIBOR plus 80. So you would think that with this overnight surprise, that U.S. Treasury yields would be up because it's just been downgraded from AAA to AA plus. But not to my surprise, actually, from the 2-year down to the up to the 30-year, Treasury yields are down this overnight. And why do I think this happens? Well, it's called the futures market. And I worked in the futures market from around 1995 to 2012. Prior to that, I worked in the bond market, but it was more in the cash market. But I can tell you, when I started out in the mid-90s, the futures market used to close in Europe around 4 o'clock, the European futures markets, the London Financial Futures Exchange, the MATIF in France, the German exchange, which became Eurex. They all used to close and open the next day in the morning around 8 o'clock. And the Chicago and New York futures exchanges, they usually closed around 8 p.m. London, which is just after 3 p.m. Eastern time. And they would only really reopen the next day. There was a Globex session, which was very thin. Very few people traded. So it wasn't a 24-hour market like it is today. But the more we went into screen trading, instead of trading on the floor of an exchange in the pit, and that happened in the late 90s, the more continuous this futures trading became because it was on the screen. And now it's 24/7. And if you think that gold and silver are manipulated through the futures market, and they are, of course, if you think they're the most heavily manipulated, then think again. The Treasury futures, they're probably the most manipulated. It's a much bigger market, much more important. So, yeah, you can bet that the major Wall Street banks that have offices all around the world, in Asia, in Europe, they're trading overnight. They're being given probably orders by the PPT. And what is the PPT? It's the Plunge Protection Team, which was really created as a result of the 1987 crash by the Fed, the Treasury, the regulators. They're trying to control things. And that's why Fitch didn't come out in the middle of the day yesterday, of the trading day, and say we're going to downgrade the U.S. It would have caused havoc. So by doing it after the market closed, and they probably did it because the futures market, they closed for about an hour. I think it's from, let's see, from 5 p.m. Eastern to 6 p.m. Eastern. So I haven't really checked what time this announcement came out, but I would bet it was between 5 and 6, and then they can react. And that's why treasuries are up, treasury prices, and it doesn't make any sense. And that's probably why gold was massively lower yesterday with silver, because the treasury, of course, they were given a heads up. They had to. I think Fitch wants to be in business for a while longer. And yeah, so that's how I see it. I think it vindicates the BRICS countries as well. So before we look at the markets, let's quickly look at what Fitch actually said about the downgrade. And it's a long report, or a long announcement, and I'm going to put a link to it in the description. And you can read it, because I see that a lot of the mainstream financial publications are focusing on the debt ceiling standoff, that Fitch has done that because of that. But it's partly because of that. So let's go through it. So here we go. Fitch ratings. From the horse's mouth. Fitch downgrades the United States long-term ratings to AA plus from AAA, outlook stable. So key rating drivers. Rating downgrade. The rating downgrade of the United States reflects the expected fiscal deterioration over the next 3 years, a high and growing general government debt burden, and the erosion of governance relative to AA plus and AAA rated peers over the last 2 decades that has manifested in repeated debt limit standoffs and last-minute resolutions. So it's part of it, but also the fiscal situation. So it goes over the erosion of governments. So let's quickly go through it. In Fitch's view, there has been a steady deterioration in standards of governance over the last 20 years, including on fiscal and debt matters, notwithstanding the June bipartisan agreement to suspend the debt limit until January 2025. The repeated debt limit, political standoffs, and last-minute resolutions have eroded confidence in fiscal management. And I'll go to the end here. It says, additionally, there has been only limited progress in tackling medium-term challenges related to rising Social Security and Medicare costs due to an aging population. And this is the one that I think is really interesting, because I've been talking about this, and many other people in the alternative as well, about the deficits, right? And I think their estimates are actually on the conservative side. But it says, rising general government deficits. We expect the general government GG deficit to rise to 6.3% of GDP in 2023. Well, I think it's going to be more like 8, but we'll stay at that. From, though, 3.7 in 2022, reflecting cyclically weaker federal revenues, new spending initiatives, and a higher interest burden. So here's the very interesting one, and we've been looking at the chart of the fact that interest service, the interest on the debt is rising towards $1 trillion, right? And Fitch has noticed that, of course, and they should. It says the interest to revenue ratio, it is expected to reach 10% by 2025, compared to 2.8% for the AA median and 1% for AAA median, due to the higher debt level as well as sustained higher interest rates compared with pre-pandemic levels. So I think this is explosive. I mean, and that's why I think AA plus is even too rich for the U.S. rating. So I think Janet Yellen, of course, is wrong, because this interest to revenue ratio is like almost 5 times the median for AA countries and 10 times the median for AAA. So there you go. As I said, I'm going to put a link to this below in the description, and you can read the whole thing if you like. So, and it's another reason why I will keep trying to accumulate physical gold and silver, because they're AAA. They will never go to junk like U.S. Treasuries probably will, and all other fiat currency government debt. Eventually they will go to junk, even the ones that are rated above the U.S. right now. And one thing I would say, normally if the country doesn't have a AAA rating, a corporate debt shouldn't be AAA, any corporations in that country. But I think that's probably not true for the United States and some of the big corporations, but that's something else to keep in mind, I would say. So yeah, make sure, if you haven't yet, or you're thinking about buying gold and silver, or if you want to help my channel, think about using my affiliates. All the details are below in the description of all my videos. So let's look at the markets now. It's 8:20 a.m. London time. So we've got spot gold trading at 1949. It's up $5. Of course, we should be way above 2,000 by now, and we will get above 2,000 in my opinion in US dollars. It's just going to take a bit of time, because the people in charge of the fiat dollar, the people in charge of the deep state, they're fighting for survival. And what do I mean by that? Well, if their funding source dries up, they can't act as they're acting now. So the money is the most important thing. Keeping treasury yields low, keeping gold and silver suppressed, that's their main goal here, I would say. But anyway, the high overnight is 1954 and the low was 1944. Silver is unchanged at 24.28. The high overnight has been 24.47 and the low 25. Dow futures is down 133. The NASDAQ futures down 136, and the S&P is down 25. So to the currencies, sterling is unchanged at 127.75. The euro is up slightly at 109.90. The dollar is down about 0.5% versus the yen, 142.70. And the dollar is up 0.1 versus the yuan at 7.19. Aussie dollar is down 0.5% at 65.77. The dollar is up 0.2 versus the Canadian dollar at 133.03. And the Kiwi dollar is down 0.75% at 61.00. To the general commodities now. WTI crude is up 0.8%, just below 82. Brent is trading at 85.50, up 0.75%. Platinum is down $5, trading around 930, and high grade copper is down 0.5% at 390. So let's quickly look at the government bond markets. Start with the U.S. Treasuries. Yeah, the 2-year yield is down 3.5 basis points at 487. The 10-year is down 2 basis points at 403. So nothing to see there. It doesn't matter if they downgrade U.S. debt. U.S. debt will be bought probably by the PPT in the futures market, and that drives the cash market. And I think Professor Fekete, Antal Fekete, the late Professor Fekete, he once said that the futures and derivatives market would grow bigger and bigger in order to manipulate this fiat currency Ponzi to keep it going. And I think he was totally right. So to the Japanese government bond market, so it looks like the Bank of Japan has allowed rates to move a little higher. The 10-year made a new high today at 0.63. It's up 2 basis points. That was, right now we're at 0.62. So maybe that's why the yen is strengthened a little bit and the dollars come off. To the UK gilt market, the 2-year yield is up just under 3 basis points at 508. And the 10-year is up 5 at 444. So with that, I'm going to wish you all a very good day. Take care. Bye.